Hello everyone, I'm Nikhil Mishra from Setu Capital. Today we will be looking into a very interesting update from Intellect Design Arena. There is going to be major changes in the business model, and there has been a major impact in the stock price as well. To give you a backdrop about this company was founded by Mr. Arun Jain and Mr. Rajesh, who is the brother-in-law of Mr. Arun Jain, in 2011. So they have also started a business called Polaris back in the 80s and 90s, and most of their most of their uh, revenues used to come from Citibank. They used to provide the in-house software for Citibank banking products. They were mainly into service-related businesses. Now, after operating Polaris for so long, they thought of rather than getting into the same old grind of a software services software, they thought of creating a product business. That's how the journey of Intellect had started. So, in order to develop a product business which was completely new in India, they had to do major capex in terms of the product development, and there was elongated cycle of 3 4 years for Intellect. So, this company 2 3 days ago posted its result, and then there was a sudden knee-jerk reaction in the stock prices. Within 2 days, the stock fell by around 17%. If we zoom out a bit, you'll find that the year-to-date performance of this company is minus 42%, and from its all-time high, it is down by around 55%. But in case if we zoom out a further a bit, you'll find that since pandemic lows, the stock has been an eight bagger, even after a large major decline in the past one year. At its highs, the company had share prices had reached around 800 900 rupees. That although it was for a very temporary period, and that too because a particular quarter was quite good. Now, this being a product business and the company is into major expansion and investment, there is a lot of lumpiness in the revenues. So that's why the stock prices are volatile in this company's case. So what were the quarterly results? The company's revenue grew by 17%. The gross margin has declined from 58% to 52%, while the EBITDA margin declined from 26% to 16%. Now there is a backdrop that this company is a product related company, and the deals are quite bulky. A single one or two large destiny deals, which they call, can change the EBITDA margin direction. This is a bit different as compared to the service related software companies, where the more technology or manpower you employ in a customer contract, the more billable hours you have. In this case, that is not the case. This Intellect has a suite of products, and which the customers purchase, and for using that product, they provide they get the revenues from it. Now, since we are on this discussion, so Intellect provides banking, insurance, transaction, wealth management, etc. suite of products. And there, as an anecdote, even RBI uses Intellect's platform for its transaction purposes. Now you can understand the level of due diligence the any vendor for to RBI has to go through. So there were multiple competitors, including the big wigs like TCS, Infosys, etc. And then Intellect had won this uh, contract. Means even in a conference call, the uh, the mm, the CEO of the company had said that it requires a complete village in order to get a contract from RBI. That is the amount of due diligence they have to go through. Now, coming back to the financial results, the Profit after taxes are down by around 42% on a quarterly basis. As per management, that since their business model is a bit different, so they should not be judged on a year-on-year basis. They should be looked in 12-month basis. So if you look into the 12th month basis, you'll find that the revenues have grown. Gross margins are gross margins are more or less at the same level of 57%. EBITDA margins have declined and PAT is flat. Now, the main reason for this declining EBITDA margin, etc., is that last year, due to pandemic year, there was very less travel. Travel costs were form a major part, an important part of the expenses. Now, since there has been a talent war because of the lack of suitable manpower, so these companies have to increase their salary of their employees, and that too at to a considerable level and with multiple revisions. So that has impacted the financials of this company. This company says that there is a growing pipeline, that the pipeline is basically the number of contracts which they are bidding for. There are other software companies also which are vying for the similar contracts from other customers, and they have a increasing pipeline, and the pursuits of more deals have increased. The average deal sizes ranges from around 5 to 5.5 million dollars. So let's look at the key metrics. In quarter two, the revenue growth rate has declined. In the last 3 quarters, in last 3 quarters, the revenue growth were considerably high. The SaaS revenue growth has also started declining, which is not being viewed pleasantly by the markets. The margins have declined because of the increasing other expenses, and EBITDA margins have also declined. Now, as per management, what they are doing is they are transitioning from product to platform business. What earlier used to happen is that if they have a customer, they are selling their product to the customers. But now, since they are trying to, in order to just enhance the appeal of their products, and in order to cater to various requirements of different clients at even at lower or higher sizes, they are transitioning to platform business. So in platform business, what will happen is that what used to get billed in 1 year will, or 2 years, or let's say 5 years contract, that will get subdivided into various quarters. Now these quarterly revenues, earlier the revenue recognition used to take place at once, but now they will take place on a quarterly or monthly basis, depending on the contract which they have with the companies. Now this will impact the revenue recognition, and this will also impact the growth rate of the company in the short term. In the short term, and there is a double whammy of means wage inflation as well as the travel related expenses coming back. In order to move transition to platform business, they also have to make more investments, which will eat away some part of amortization costs. That will increase the amortization cost, as the employee cost have more or less come back to similar levels as pre-pandemic. Looking into the valuations, I have made a chart of more or less the mid-cap technology companies, which is a combination of most of the uh, good uh, companies considered means worthy of investment, with Tata Elxsi, L&T Technology, Persistent System, Coforge, KPIT, etc. We have made a comparison of the valuation along with the return metrics as well. So you will find out that the ROE and ROC of Intellect Design, which is a product company, compared to the L&T and Emphasis, which have a relatively lower component of product business, and this is purely a product business with a superior with a superior future growth rate expectations and stability and stickiness of customers with high margins. The ROE, ROC of Intellect is around 21% and 24%. The price to earning ratio of Intellect design is among the lowest. If you leave aside the Oracle financial services, which have relatively lower growth rate and is of which is the growth rate of Oracle financial services is relatively less, and that's why the market is not that enthused about it. Leaving aside Oracle, Intellect is present at its least value. Least value. This company is purely a product business, and it has demonstrated in the past that it can grow its sales at higher growth rates. Now, going forward, this company expects a 20% top line rupee growth, 20% EBITDA margin. Now, in the last year, they had they had generated around 22% EBITDA margin, and this year they expect 20% EBITDA margin. The rupee growth they expect to be in around 18-20%. The British pound has also devalued as compared to the US dollar. So there might be some impact of that in if you consider in the dollar terms. They are going to increase investment in platform business, which will increase their manpower cost, and that will affect the bottom line of the business. Now, management believes that in order to take it to a next level, it will have to make investments. So, the outlook for the upcoming 1 year, I would say, is a bit subdued in terms of compared to the previous guidances which it had given, and that's why the market has reacted so negatively with with around 17% decline in stock prices within 2-3 days. So this brings us to the end of this presentation. I hope that the information provided by me has been useful to you. None of the discussions considered should be construed as investment advice. I am biased. I have a holding in this company, and that's why we do track and share information with you. It's better for you to consider and consult an investment advisor and do your own research before investing in any company and in Intellect as well. So, if you did like my video, just do like it, and don't forget to subscribe and press the bell icon. That would help us to create more content. And in case you wish to get in case you are interested in hearing and learning more about small and mid cap companies or micro cap companies, then do subscribe to our channel. For any stock and mutual fund related services, do call us. We'll be happy to help you in your wealth creation journey. Thank you. Thank you very much.